We've all been told that tokenisation enables near-instant settlement from T+2 to 0 and dramatically lowers operational costs. But that all sounded a bit abstract to me. So I thought I'd hear it from the horse's mouth and find out what the real incentive was. What Alastair said surprised me. And it's why Aviva Investors have recently announced they're launching tokenised share classes of their existing money market funds. First and foremost, it's to reach new investors. Alastair explained that Aviva has established relationships with corporates and pension funds, but there's an emerging investor base that they're acutely conscious of: blockchain native companies. These are real regulated financial businesses, but they exist entirely on-chain rather than through traditional financial infrastructure. These companies want access to tokenised assets for treasury management. So as this space grows, Aviva is well positioned to capture that demand. So how does tokenisation actually benefit the end investor? Alastair explained that different clients have different operational problems they want to solve. For blockchain-based firms, as I've talked about, it's the ability to access assets on-chain. For corporates operating globally, it's a combination of stablecoins and money market funds for cross-border funding. They want the ability to move money around the clock so they don't have to hold large cash buffers not earning a yield, waiting for the banks to reopen in different time zones. And for hedge funds, it's collateral management. They typically have to post traditional collateral days in advance to account for settlement time. That's money sitting idle, earning nothing. Tokenised collateral settles immediately, so they can post it at the last minute and keep their capital invested right up until it's required. So what's the risk for an asset manager if it doesn't start looking into this now? I asked Alastair why the industry as a whole hadn't moved faster. He said asset managers have competing priorities, AI especially, and frankly, the return on investment isn't immediately clear. So why do it? Because the real risk is waking up in 5 years' time and realising you've been left behind while your competitors have captured this fast-growing demand for tokenised assets. There was something else Alastair said, a vision of the future I had never considered. There's no reason why you can't tokenise any asset, stocks, bonds, real estate. He pointed out that in the future, investors will no longer have to choose from fixed multi-asset funds. They'll have the ability to create their own completely bespoke portfolios, instantly mixing and matching assets on-chain. And with that level of complexity and choice, he thinks that both providers and investors will increasingly turn to AI to help design and implement portfolios. So if you're an asset manager juggling lots of competing demands right now, exploring how you might go about tokenising your assets might well be worth putting higher up your priority list. Thanks for watching, and thanks to Alastair for sharing his insights.